This is Anthony Galliano for B2B Cambodia with a special segment, Tariffs versus the Financial Markets. The word tariff is dominating the news, causing anxiety and deep concern with the United States trading partners and disrupting the world's economies and financial markets. The chaos is not only due to the size and scale of the tariffs and the inconsistency of their application, but their on and off again and pauses. As a reminder, here is a brief history of the key dates of the tariffs that are impacting most of the world. On April 2nd, a 10% tariff is applied to all nations importing goods to the United States, unless a tariff had already been announced on a product or industry. On April 9th, the White House implements punishing tariffs on some of America's biggest trading partners. Chinese goods are subject to a 104% tariff. European goods faced a 20% import tax. Japanese goods were taxed at 24%. Vietnam products at 46% and Cambodia at 49%. Later in the day, an abrupt reversal. The White House said they would back down on reciprocal tariffs for the next 90 days, bringing tariff levels to a universal 10%. There were many reasons attributed to the tariff pause. Willingness for countries to negotiate trade deals. Apparently, the 90-day pause on tariffs for most countries was intended to provide a window for trade negotiations. Increasing voices in the business and financial world, sounding the recession alarm. Concern that escalating tariffs could deter consumer spending. The International Monetary Fund and European Central Bank warning that trade tensions could slow economic growth. The ECB even reduced interest rates, citing exceptional uncertainty stemming from the tariffs. By pausing tariff hikes, the White House aimed to stabilize the economy and maintain political support amid growing concerns over the trade strategy's effectiveness. Several days in which the president said the falling stock market didn't bother him. The markets continued to slide, emerging problems in the bond market, and the falling value of the dollar became impossible to ignore. In fact, many believe it was the bond market that convinced the White House to pause tariffs. As yields rose, liquidity dried up, concern accelerated that foreign governments were selling U.S. bonds, and the safe haven status was dissipating. So what are the key financial market metrics to watch in this tariff chaos? Potential global economic slowdown and trade tensions. Number one is the 10-year bond yield. The 10-year bond yield acts like a warning siren. When it drops, it warns that the trade war might crash the economy. As the administration's reciprocal tariffs went into effect, bond prices slid, and the yield on the 2-year Treasury note rose more than 0.3 percentage points, marking the biggest intraday move since 2009. The 10-year yield saw its biggest 3-day jump since 2001. That pushed bond prices lower and boosted yields. So what does this mean in simple terms? It is believed there is 130 trillion US dollars of debt in the world. The world runs on debt, and these bonds are widely considered to be the most powerful political force in the world. When bond prices drop, interest rates increase, meaning the cost of borrowing for a country starts to spike. In particular, the US government has to pay higher rates on debt. For the consumers, pricing a higher cost of borrowing slows down the economy as people can't afford to borrow. When yields went up, fear grew that this could ripple outward and cause a financial crisis. There was an absence of liquidity, causing deep concerns that the US would have trouble refinancing its debt, and the US bond market was losing its safe haven status. The bond market drop was seen as an unprecedented attack on America's global financial dominance. I am also watching the S&P 500 index. The S&P 500 index features 500 leading U.S. publicly traded companies with a primary emphasis on market capitalization, and is considered one of the best gauges of large U.S. stocks and even the entire equities market because of its depth and diversity. The S&P 500 is a key indicator to watch during periods of tariff chaos because it reflects the overall health of the U.S. stock market and can signal the market's reaction to trade policies, economic uncertainty, and investor sentiment. If investors are selling, it suggests they don't see how tariffs can do anything but potentially throw the U.S. into a recession and are now rushing to yank their money out of the market. On Inauguration Day, the S&P 500 closed at 5,996. It closed at 5,262 on April 17th, down 12%. A falling stock market indicates concern for corporate profits and the U.S. economy. The stock market and economic performance are aligned. If the stock market declines, it reduces wealth, deters consumer spending, diminishes corporate market values, leads to businesses to invest less or delay investments, and impacts retirement savings, extending possible retirement age. Finally, I'm watching the US dollar index. The US dollar index is an index or measure of the value of the United States dollar relative to a basket of foreign currencies, often referred to as a basket of US trade partners' currencies. With the announcement of tariffs, the dollar effective exchange rate sharply depreciated rather than appreciating. G10 currencies appreciated, implying that foreign advanced economies reduced exposure to the US dollar-denominated assets, selling dollars in favor of other major currencies to rebalance their portfolio, as trade flows cannot adjust instantaneously. The US dollar's dominance has rested on two pillars: America's deep capital markets and its global security alliances. Today, both are under strain. Shifting U.S. foreign policy, rising geopolitical uncertainty, and overextended stock markets are making investors and policymakers reconsider their exposure to the U.S. dollar. The U.S. dollar's dominance is slipping amid a highly concentrated stock market and shifting global alliances. So keep your eye on the 10-year U.S. bond yield, the S&P 500 index, and the U.S. dollar index, which will influence tariff policy in the end and whether we are headed for a global recession or worse. You could find this information on our website and, of course, all the financial markets, interest rates, commodity prices as well. This has been Anthony Galliano with a special segment, Tariffs versus Financial Markets.